and is not examining the relationship between principal and agent. It does not do that. It assumes that people are motivated to obtain desirable rewards and avoid punishments. Duh. Okay? Most of us can go along with that assumption. Incentive systems must provide desirable rewards and a high likelihood that the rewards will follow prescribed behavior. Now, makes sense to quite follow that. So here what I have is an example of Porter and Lawler's extension of agency theory. And so we're going to build a couple things on here that I think are salient to the discussion, especially when we want to examine reward systems. The idea here is that if I put forth effort, then I will get performance. Put forth the effort, I get the performance. And there's a reward that I'm looking at over here that I expect to get if I perform. And when I get that reward, I will experience satisfaction. Now, there's one thing about the Porter and Lawler model that looks at some moderating variables here. One of these is traits and abilities. You can put forth all the effort you want, but if you don't really have good ability or the traits in order to do the job, it's probably going to affect when you get to the performance. For example, I always wanted to be a linebacker for the Pittsburgh Steelers. I could have put forth all the effort in the world, and I would have had very poor performance, as well as probably a fair number of injuries. So that's not going to happen, because I don't have the traits and abilities to do that. So that's a moderating variable. And that means you better have the right people in place to put forth the effort if you expect to get the performance. You can't just simply say, here's a reward, make it happen. They don't have the things necessary to produce that. Also, in the moderating variable, they include role perceptions. You better know what your role is in the organization, because if you're doing the wrong thing, you're not going to get the performance. Right? If you're not doing what your role is, you're doing somebody else's role, you're not going to get the performance. So, two moderating variables, traits and abilities, and role perceptions affect whether you get performance. Why do you want to get the performance? Why are you putting forth the effort? Because there's this extrinsic reward over there. Could be money. But another interesting thing that Porter and Lawler include is this idea of intrinsic rewards. Sometimes you get things like, I feel really good doing a good job, right? I feel better when I do a good job. So often there are intrinsic rewards. And places where you'll see intrinsic rewards used a lot are places like the military uses a lot of intrinsic rewards. Right? It's interesting that agency theorists will argue against the existence of intrinsic rewards. You couldn't possibly feel satisfied. You know, it's only the extrinsic rewards that matter. So they have their long papers that argue whether this actually exists. You haven't thought about that. How many of you ever felt good about something that you did in your job? All right, yeah, you know, so for you folks, it's probably going to be difficult to argue that there are no intrinsic rewards. And again, places like the military rely on intrinsic rewards primarily to get that effort to put forth for performance. I mean, if you would take the military example, not that it's the only example, but you know, analyze things within this framework, because they want to get the effort put forth. They do a lot in terms of selecting people, testing them psychologically, training the heck out of them, and they make sure you know what your role perceptions are because you have a rank. They make that real clear what you do, and you have a particular occupation that you perform. So you can see that they're trying to balance out. I'm not sure they sat down with one of these, but over time they figured out we got to have the right people, and people have to know what they have to do, so that if they put forth the effort, then we'll get the performance. And then what do we rely on? They use all kinds of things like camaraderie, cohesion, little ribbons you can wear when you win them, you know, little purple hearts when you get shot up, those kinds of things. The intrinsic rewards that they use, because they're extrinsic rewards, they don't pay huge bonuses, right? Oh, you shot somebody today, we're going to give you an extra $2,000 or something like that. They can do that. You can see then that how you can take the attributes of a particular organization and kind of look at them in this framework, and it might be helpful. If I get the intrinsic and extrinsic rewards because I have the performance and I get the satisfaction, then that satisfies this one. One of the other moderating variables here would be the perceived equity of the reward. Did I get as much as I think I should get for what I did compared to other people? And that leads into the whole idea of equity theory, which I'm sure you've talked about in other classes. Okay, so now, so I get the satisfaction if I believe there's equity. And that performance, then, if that's the satisfaction, will affect my perceived effort, reward, and probability. How often is it that I'm going to get the reward if I actually put forth the effort? And that will affect my future efforts. And this will also affect the perceived equity of the reward. And then that satisfaction tells me what the value of the reward is, which then affects my future effort. So this is maybe a little more complicated model, but you can see that it's rational and well thought out. It's also been, parts of it have been fairly, over quite a number of years, been empirically tested, and various tenets in it have been supported. All right, so this is a very different view of the world than the agency view of the world. The agency view of the world, you know, I'm going to use rewards, and I know your traits and abilities that you're work averse and you are risk averse, right? And I know that you see your role perception as trying to get stuff away from me as principal, and that you'll exert effort to do that, right? Then they get performance. So then the idea then is, from the agency point of view, and also from the expectancy point of view, is how do we structure these rewards, extrinsic and intrinsic rewards, in order to get performance, which is what we're after. And obviously here, you better get the right people and have them trained well and have them know what their job is. All that stuff is really laid out more explicitly in expectancy theory than it is in agency theory. It's interesting, though, that the agency theory appears to drive most of the choices for reward systems. Okay, given that rewards are important in both expectancy theory and agency theory, is there any question why extrinsic rewards, for example, merit pay, paper performance, etc., are ubiquitous? What that means is there any question why extrinsic rewards are used in most organizations, especially as you go higher in the organization, among A-level executives, E-level executives? You're more likely to find merit pay, paper performance, etc. Rewards are important in both expectancy theory and agency theory. Is there any question that rewards are motivated? Is there any question that rewards lead to superior organizational performance? A little interesting. There's some issues. So external rewards conflict with internal motivation. In other words, I have an external reward. Does that affect my internal motivation? There's a thing that's been examined here called post-reward performance lessening. After I get the reward, I don't put forth too much effort. We already got the reward, right? So that's been a documented effect. Are there any negative effects associated with pay performance? Well, one of the things that happens when you have pay for performance is you're transferring risk to the agent from the principal. That may be a good thing, right? Maybe a bad thing. It's too much risk. How much risk should you transfer? How do you decide what that amount is? But the agent starts out, and if you think of an agent as being paid a salary, there is no risk. I know what I'm going to get. If I start now paying the agent based upon some other measures that the agent can control, there's some risk there. But what if I include measures for which the agent can't fully control them? Then they are really bearing more risk. And in general, when you bear more risk, what do you want? More reward, right? So you can't just, if you increase the level of risk, then it's going to be necessary to increase the level of reward, potential reward, right? There's also the problem of multitasking. I'll give you a very simple job. Very simple job is Joe works down on the assembly line and takes subassembly A and subassembly B and puts them together and takes a 19mm box end wrench and goes boom, 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 and off it goes. Right? Can I look at what Joe has? What's Joe's tasks that Joe has to perform? Joe's got to take component A, subassembly A and subassembly B, put them together, boom, boom, boom. There's not a whole lot that Joe's got to worry about other than doing that, right? In that sense, I can count the number of completed A and B assemblies and say, that's your output, Joe, no problem. I can reward you, go faster, and putting those sub-assemblies together, and you'll get more pay. Of course, what's the tendency then? Well, let me see. If I took my 19-inch box end wrench, and I went 1, 2, 3, 4, 5, 6, 7, I could do more of them if I just went 1, 2, 3. Right? Now I won't do all those. So now maybe they're not as tight. So then we have to introduce a control system. So the last thing you do is you have to torque it with a torque wrench. Now we have to understand. Had to put control into the problem introduced by the reward system. Right? Put a control in place. Anyway, that's a very simple type job. When you start talking about more complex jobs, take Michael Hegarty in the case that we just looked at. What are the dimensions of performance for somebody at that level? Man, you got to be doing a lot of different things. You're not just putting these things together. You've got to be thinking about strategy. How do I structure the firm so that it will be able to compete in the future with sustainable competitive advantage? And how am I going to get a culture together that will work to achieve the change that I want, and what kind of control systems am I going to? That's not the same kind of work, is it? It's not the same thing you can count. So what you might do is say, well, I'm going to reward you based upon our increase in sales. Pretty short term, right? Because I can measure that easily. I can't see that. What is there going to possibly be a tendency to do? What's that? Focus on sales. That's what's being rewarded. Excuse me just a second.
I promise you won't get sick.
They're not.
You're not going
I've
to.
already been getting sick.
I'm sorry. Well, if you get sick, then it's not my fault.
Yeah, it is.
I'm not doing that. What is that?
No, it's exactly how it is.
That too?
Okay, so you're going to have a tendency to focus on the sales, which is the thing that's getting measured, and what are you going to do about the long-term strategy, kind of formulation and all that? You're probably not going to focus on them as well because they're not being measured. And that's the multitasking effect. The things that are measured and rewarded are the things that you focus on. And the things that are not measured and rewarded don't get as much attention, which makes sense. But that's the multitasking problem. So what would the response be to that? Well, let's measure and reward everything that you do.
Yeah,
Right?
exactly.
But then we're left with a good place to the whole idea of performance measurement. I'm going to take a little break and talk about this for a second. Here's some quotes about performance measurement. When you can measure what you are speaking about, express it in numbers, you know something about it. Otherwise, your knowledge is of a meager and unsatisfactory kind. That's a view. So you better be able to measure it in numbers or you don't know, you can't talk about it. And that was from George Kelvin, a very smart person who lived from 1824 to 1907. In fact, he even got a temperature scale named after him. So smart. All right, so when you can measure what you're speaking about and express it in numbers, you know something about it. Otherwise, your knowledge is of a meager and unsatisfactory kind. Well, here is another one. Not everything that counts can be counted. Not everything that can be counted counts. That's from Albert Einstein, who's also a pretty smart person. Right? So, what's this thing? Not everything that counts, not everything that's important, can be counted or measured. And not everything that can be measured is necessarily important. Okay, so you may not be able to get something other than knowledge of a meager and unsatisfactory kind, even on something important, because you can't get it in numbers, because you can't measure it. So when we come to the idea that, well, let's just measure everything and reward everything, not everything that's important can necessarily be counted. So you have sort of a problem, don't you? So taking this together with another quote here. The moral is that precise measurement or calculation of a thing is profoundly different from the interpretation, significance, and meaning of that thing. The act of measuring it is different than trying to interpret it, or whether it's important and whether it really has meaning. Meaning is important, not measurement per se. Okay? We confuse the two because measurement appears to be precise, objective, and simple. It is not any of those. Whereas meaning appears to be vague or at least flexible, subjective, and complex. It's all of those. By overemphasizing the first, that is measurement, at the expense of the second, that is meaning, we are vulnerable to the bean counter's paradigm. If it cannot be quantified or measured, it has no significance. This is from Jack Wade. So that kind of ties down, I think, those quotes, I think, sort of lay out some of the problems with trying to measure things and getting everything that's important if you want to reward people based upon things that are important, right? If you don't get them all, then you're going to leave some things out that are important. If you can't measure something. So with that, that's keep that in mind as we go back to wrong one, wrong answer. They all go. I have no idea. We'll get at that. Sometimes I just hate Microsoft.
But you'll hate Mac more.
What's that?
You'll hate Mac more.
Really? It's funny, I've got 3 Macs, I don't hate any.
Guys, you need 3.
I have both, you know, I have.
I know, you only have 1 Windows and 3 Macs. So
No, I have 3 Windows, 1 Vista, 1 XP.
a little variety in life.
All right, so here's where we were. And we got down to the multitasking issue, and the only way around that was if you could measure everything in a complex kinds of job. You can't measure everything. So then some things that may be important may be left out. And it also introduces potential incentives for non-cooperation. Because if I'm giving personal rewards, generally, there is a reward pool. And that is a pie that has to be split up. And if you get a bigger piece of the pie, I'm not going to get as big a one, right? So if we're really saying that you're really only motivated by the reward, why should I cooperate with you? Because you're trying to take my money. You're trying to eat my lunch. I don't like it. So, I mean, that could possibly then introduce these potential problems for introduce non-cooperation, and it might be simply to, oh, I'm simply not going to cooperate with you, to doing what? I could sabotage you so you don't do well at all, and I'm more likely to get my money. So the idea now is, what is the ideal mix of incentive rewards and base pay? Because the more incentive rewards I have relative to base pay, the more risk is going to be involved. And you might see that there'll be a philosophical difference here. I want to have my employees have a lot of risk, because then they'll really be motivated to do a good job, right? So I have small base pay, big risk, or a big potential reward. Another way would be, well, yeah, you've got a script if you do better, but you know, you do have this base pay, which is then lowers the risk for the agent. So, what is the ideal mix? That's an issue. Should it be a supplemental boost, or should it be the driving force behind your incentive system? Okay, so incentive systems require measurement. Not all tasks are equally measurable, as we've just talked about. Things like innovation. Now, how do you measure innovation? I mean, it's a long-term kind of process, like R&D, innovation, R&D, those kinds of things are more difficult to measure in their long term. How do many organizations, you will have a mentor or serve as a mentor. How do I measure your performance as a mentor? And how do I factor that into your performance pay? That's not nearly as equally measurable as Joe put subassembly A and subassembly B together and then torque it to 10 foot-pounds. So if we use objective, we want to be objective. We have a formula system. Those tend to be biased because we have imperfect performance measures. So that tends to bias in a system that's completely an objective formula. They are biased by multitasking and measurability issues. So then we can have subjective systems. Well, we're not going to be using an objective system, let's use a subjective system, right? And that may mitigate, but if you have a subjective system, these may be subject to curry in favor of the evaluator. In other words, it's a nice way of saying what? You're evaluating me, I'm going to kiss up and do everything I can, right? That's curry in favor. I'm going to kiss up to the evaluator. And it may lead to undervaluing by the principal. In other words, if the principal is doing the evaluating, if you do really well, I'm going to pay you more. Maybe I'll just undervalue what you did. What's that? Well, just undervalue what you do, right? And then it's also subject to reneging by the principal, It's subjective, right? I mean, you may not do it. So, we've got problems with these incentive systems. So, do we have subjectivity and objective systems? Yeah, rewards are based on measurements that appear to be objective, period. However, there usually remains a subjective component in the interpretation of the measurement. So even though I get the measurement, I have to interpret it. Right? That's what we need. That leads to something that's been called the outcome effect. If you're a manager of a store that's doing really well, obviously you're doing a good job, right? And if you're a manager of a store that's not doing very well, or as well, you're not doing as good a job. So let's say that you have a manager of a Tiffany's Jewelers in Manhattan, and a manager of a Tiffany's Jewelers in Colfax, Washington. Do you think they're facing the same set of opportunities? All right, so the store in Colfax, Washington would not be doing as well as the store in Manhattan, right? Probably not. With basic wealth, there should be. What's that?
There's a lot of wealth here.
Nothing like your Manhattan. Trust. Trust. So, all right, we'll make it. Let's make it. Viola, or down on the river. Down on the river,
Garfield.
Yeah, Juliet of Washington. Tiffany's and Juliet or what? Okay, I think it's shares of one. Okay, so there's the outcome effect where we tend to conflate the results with your performance, when in fact, you may not be facing the same opportunity set, and you may have done a really good job in Juliet at getting the level of sales you had, but we're not going to create weight here as well. Also, it leads to a weighting effect. Might change the way that we weight things. An example of this is with retail banking managers. There's the subjective component is how you weight stuff. So blending subjective and objective systems may be the best. So here's our pay for performance summary. Incentives can attract better workers and increase effort. Workers manipulate the quality and timing of their work based on those incentives. There may be unintended consequences. The appropriateness depends upon the degree of multitasking, the measurability of output, and the worker's risk overcome. Right? So all of those things are things that have to be considered. So a blend of objectivity and subjectivity may be functional or dysfunctional. Depends on the person. Here's another quote for you. If people are good only because they fear punishment and hope for a reward, then we are a sorry lot indeed. And that's Albert Einstein too. So I think this is a very interesting area in terms of how people react to rewards, and also interesting in terms of our perceived ability to design systems that will work well without unintended consequences. And we'll see some more of this in our readings later. Okay. Any comments or questions about that? Well, what are some of the ways that these incentives, what are some of the ways that these incentives are used? And so what kinds of incentives might be used? Incentive compensation takes various forms. The purpose is to promote goal congruence between managers and shareholders, right? That's the purpose, stated purpose of using incentive compensation. And that's goal congruence business comes right from agency, right? Managers' actions should be simultaneously in the best interest of both managers and shareholders. Forms of incentive compensation include cash. We'll give you a reward. Or we'll give you a stock reward where we give you shares of stock. Right? Meet your goal, we give you cash. Meet your goal, we'll give you shares of stock. However, those may have some tax implications. You can also get stock options, which is the ability to purchase a stock at a stated price at some time in the future. Usually there's a period of time where we cannot exercise the option, and maybe a time when we can. The idea being there that if the value, I do things, the value of the stock goes up, then I will be able to sell it, buy the stock, and sell it, and make a big reward. And then there are performance shares where, based on performance, you can share stock. There are stock appreciation rights where it's based upon how the stock appreciates over time based upon the change of the price of stock, and it's called participating in cash or stock are current bonuses of cash or shares. However, they're the same as income for taxes. So if I give you the money, then you got to give some of it back, right? Or if I give you shares of stock, you may have to sell some of them to pay the taxes. Okay, so stock options, this is the right to purchase company stock at a future date at a price established when the option is granted for a period of time over which cannot exercise the option. The purpose is to strive for long-term performance. There's no downside risk because let's say that you have stock options and the point at which you could exercise the option happened after the collapse of 2008 when the stock market went down. Well, I did all that good work, right? I got this option. But then, and I still did good work after that, but outside of my control, the general market risk brought the price of the stock down. But I don't lose anything, right? Because I'm just not going to exercise the option. So, let's say that you turn that around. The price of the stock might have increased, without bounds, in which case you have unlimited upside. So stock options are recognized as compensation expenses according to the fair value method of AS 123 bonds. So it used to be that you were able to keep them off the books as compensation expenses because how can we value an option? You don't know it's going to be exercised. So we now have ways around that. Stocks are black shoals. Okay, then we have performance shares. These are stock shares awarded to managers to achieve performance targets and to remain with the company. The focus is usually on a 4 to 6 year time horizon. And if you go and look in proxy statements, you can find these performance plans laid out, and it will lay out kind of how this happens as well get to the stock system. If they're awarded as a bonus without additional cash, so you may have to have tax involved with that too. Stock appreciation rights are deferred cash payments that are based on the increase of the price of the stocks from the award date to payment. Right? So you give stock appreciation rights, and then you look at how much the price of the stock changes, and we give you a cash payment on the end based upon the increase in the price of the stock. Participating units are deferred cash payment that is a function of operating results rather than stock price. So we might have a formula we put together based upon market share, return on assets, net operating income, those kinds of things. It would be operating results, and we give you a cash payment in the future based upon that, rather than on stock price. So what I wanted you to see here is there's lots of different ways that people have put together incentive ways to put incentives in place. Right? And most of them have features in common. They're forward-looking, not direct bonus at the bigger point in time. But many of these are forward-looking, want you to stay with the company and trying to get you to do more long-term decisions. Some unintended consequences could lead to something we call earnings management. But we're all managers, aren't we? With earnings management, we do it. Yes.
That's like it's important.
Well, the idea behind earnings management is you are making choices and accounting for things in such a way that it makes the earnings look very predictable, or that we would want to show the numbers necessary to get our bonus. That's an unintended consequence. In the extreme, it becomes fraudulent financial reporting. That fraudulent financial reporting results from intentional or reckless conduct. So that's one of the requirements for it to be fraud. It also has to be material in amount. So if you have a material misstatement that was intentional or reckless, then you probably have grounds there for fraud. Now, those of you that are also law students know there are some other significant things that have to be usually too deep. So what kinds of fraudulent financial reporting do we get? One of them is improper revenue recognition, counting something as a sale before it's actually sold, generally we can't count revenues until they are realized or realizable and they are earned, right? And they aren't earned until, if I'm selling you something, you get the something. Then they're earned. So we can count revenue before it's realized or realizable. Count it before it's earned as well. Other ways we might get fraudulent financial reporting is through inventory manipulation. For example, we might overstate the value of our inventory. And one way we could do that, let's say that you're in a high-tech area. You have a reserve for obsolescence, which is a contra account. You have a reserve that does this stuff, loses value quickly over time. You know, that reserve. If I make the reserve smaller, it has the effect of making my inventory look like it's worth more. That would be an example of overstating the value of my inventory. Or I could just lie, so that I have more than I actually have. What's that? What's that? So we could ignore obsolescence. We can use improper classification, which was very popular. We can classify expenses as assets. This is one of those win-win situations, right? Because by classifying expenses as an asset, what does it do to my expenses? It makes them smaller, right? Which makes my income higher. And it also makes my assets bigger, right? So in the case of WorldCom, they had what should have been properly classified as expenses for lease lines, period of time of which they had excess capacity. So rather than booking that excess capacity as an expense because it expired, they capitalized it, made it an asset. It was material in amount, $3 billion. Okay? $3 billion swing in income right there. And it was intentional. So we can misclassify business units. This was done at Enron. We have special units that we formed that we said should not be treated as consolidated onto our book because it meets these various rules. The rules say you can't have related parties associated with them, and they did. So they should have been consolidated. So we just simply misclassified the business unit and got it off the balance sheet. Enron. But that's another form of improper classification. And etc. You got the flavor. So then that means we have to introduce some controls to defer fraud. And probably the most important of these is the tone at the top, which is the culture of the organization, the leadership of the organization. The leadership of the organization put forth a view that we will not tolerate improper behavior. That we are here to do the right thing. If they're there saying, we're here to make numbers and you get them any way you can, that's probably the wrong tone at the top. And then we'll also put in place internal controls. And internal controls are in place. We're going to talk more about those. Internal controls are in place to identify errors if they occur and correct them, and also to detect errors, potential errors before they occur. Our authors include here as a control to deter fraud internal auditing. All large organizations have internal auditors, and if they are properly staffed and have the requisite competence, then they will be conducting internal audits and looking at relationships, which would then further deter fraud if you had an active internal audit organization. Then our authors include independent or external auditors, and that was one that you could get an argument of some sort on. That is really there to deter fraud. It's there to render an opinion on financial statements. That's slightly changed a little bit since 2009. Also, we have penalties for fraudulent financial reporting. There are civil penalties. For example, if you were one of the people perpetrating the fraud and somebody who relied on you and had a loss is going to sue you. They will also probably sue the accountant. For example, Lehman Brothers, the current news, their failure was such that they are, being really hit with lawsuits because of some improper reporting, and also probably Ernst & Young, their auditor, will be sued as well. There are also criminal penalties. Some of those come under the Foreign Corrupt Practices Act of 1977, and some of those come from Sarbanes-Oxley 2002. The Foreign Corrupt Practices Act came about, it sounds like we shouldn't be bribing people. It has some bribery provisions, but it also has accounting provisions, because one of the ways you can get money to bribe people is by keeping a slush fund. Right? And you do that by having weak internal controls. So the accounting provisions require maintenance of accurate books, records, and accounts fairly reflecting in reasonable detail the transactions and asset disposition of the firm. And what was interesting is that was the first codification of requirements for internal control systems, and that was in 1977. It requires also maintenance of a sufficient system of internal accounting controls. Okay? Penalties under this are a fine of not more than $10,000 for imprisonment of not more than 5 years, or both. Okay? So, probably a fine of $10,000 is not all that deterrent. Prison, probably more deterrent. Okay, those now, we have some additional penalties that we'll talk about under So how do frauds take place? Called the fraud triangle. And the idea behind this is we have three elements that usually take place when there's a fraud, financial fraud. One is there's some pressure or incentive on employees to misappropriate cash or other organizational assets. You could also say there could be pressure on employees to make improper journal entries. Right? Pressure on employees to classify things improperly. There's pressure on them. What kinds of pressures might be there? Pressures or incentives. How about somebody screaming at you saying we have to make the numbers? Or somebody telling you, you know what? I want to make a topside journal entry here. We're going to classify those lease line expenses as capitalized. You gotta do that. You're gonna sit there and go, ooh, yeah, I shouldn't do that. So you have these pressures and incentives that might be the thing that is causing people to think about doing fraud. But you also have to have an opportunity to do it. An example would be if the fraud were simply that you were going to be stealing assets from your firm, then you have to have assets that do not have locks on them or guards, right? You got to have that. So you're going to have opportunity as well as pressure and incentive. So what do we do to eliminate or to reduce the opportunities? We're going to put internal control systems in place to reduce the opportunity for that fraud to take place. We're going to have deterrence in there so that the opportunities are reduced. What do we do in terms of the pressure or incentives? That's where the tone at the top comes in. We're going to do things, we're going to report the actual economic condition of the firm. That's what we're going to do. We want to fairly reflect the financial condition of the firm. That's what we're going to do. Top management's saying that. They're not saying make the numbers no matter what. What about incentive programs in terms of pay? If I have you bear a lot of risk, so that most of your compensation is based upon those numbers, then what's that doing? It's putting a lot of pressure on you to make those numbers so you can get paid. So these two, we know kind of what causes pressures and incentives, and we know about putting controls in place so that we can reduce the opportunities. Here's another one that I find to be really interesting. That's the third angle in the triangle, which is rationalization. You start telling yourself things so that you are actually going through a self-deception. And I'm going to talk more about those things later. But an example might be when the person who's the chief financial officer at WorldCom comes in and says, we're going to make that topside entry, and you're saying, well, you know, I probably shouldn't do it, but you know, Scott is really smart, and he's the CFO, and he wouldn't tell me anything that's not right. That's the rationalization, rather than saying it's not right. Okay? And other ways that those rationalizations take place is we start off with something little, and then do more, and then do more. So you kind of get incremental approach where you say, well, good, we did this last time, it was okay, so I guess it's okay this time. Or if this is like what we did last time, sort of. Things can move farther away. So these are the three things that you can look for in most every financial fraud that you see. There were temptations, there were opportunities, and there's some rationalization that takes place. Of those, we know more about the processes of incentives and opportunities than we know about rationalization, so we're finding out. Okay. So let's see. This is what I would like you to do for next time. I'd like you to look at a reading. One, two, financial incentive. Drive company performance. One reading. And then the ethics. Internal ethics of management. And the information on where those articles are and on the syllabus as usual. And remember that, take a good look at the syllabus. I don't want you to read all of that ethics of management control system, developing technical and moral values. Just do it as it says on the schedule, page 83 to the top of 91, because otherwise you start going off the deep end. All right? I don't want you to go off the deep end. Read that part. It's kind of a nice summary. Then I'd like to take a look at problems. Well, 37 and 38. Okay. No, not calculation. All right, any questions, cares, concerns, complaints, or other issues? If not, nice to hear.